Aloha, I'm Carl Bonham, the Executive Director at UHERO. In this UHERO focused video, I'll share our fourth quarter outlook for the Hawaii economy. It looks like that mild recession we've been talking about is probably arriving right now. The good news is it's probably going to be a little bit milder than we had originally expected. But the recovery, which we think will begin in the second half of 2026, will also be relatively weak. But before we discuss what's sort of driving this downturn, let's talk briefly about the short-run impacts of the longest federal government shutdown in U.S. history. So we know many federal civilian workers in Hawaii went without any pay for 6 weeks. Fortunately, they are now receiving their back pay, and programs like SNAP have been restored. So the economic hit that Hawaii experienced in the fourth quarter was mostly going to be reversed in coming months. Of course, not all the spending that was missed is going to be made up, right? So if you didn't get your hair cut in October, then the barber or the salon isn't going to get paid for that by you getting 2 haircuts in December. And so that means that there's a lingering drag. If you look at our estimates of how much this cost Hawaii's economy, around $300 million, maybe a little bit north of that, or about 0.3% of state GDP for the year. Longer term, when that spending gets made up, it'll be more like 0.1%. Now, the real issue is that federal government shutdown came on top of a very weak economy and was a drag in the fourth quarter of the year. And that weak economy was being driven by a pretty weak summer for tourism. So to understand why Hawaii was going through that sort of weak patch, that slowdown, let's talk about the national economy. For the national economy, your main driver is really consumption, and consumer spending really had some weak spots in the beginning of the year, but then we saw a rebound in the third quarter. It's been very uneven, and part of that is the tariffs. Part of that is the fact that consumption is really being led by the highest income households, the ones who have the most stock market wealth and have seen that stock market wealth surge throughout this year. At the same time, labor markets have been much, much weaker than a year ago. Of course, we're missing a bunch of data there, right? We don't have data for the September and October October and November numbers for payroll jobs, and so we look at the private sector data, and it suggests to us that there's been very little job growth, and of course the unemployment rate has also increased. Now, put the tariffs on top of that, and the tariffs are driving up consumer prices. The blue line here shows consumer inflation, actual consumer inflation, US CPI inflation, and it's been up every single month since the big tariff announcement in April. The gold line shows what we think inflation would have been without the tariffs. And so this is basically a one-time price increase. And if you look at estimates, the Yale Budget Lab estimates that the typical household in the US is looking at about an $1,800 per year cost increase. And so that's leading consumers to cut back on consumption, to substitute other goods that aren't subject to tariffs, and it's acting as a drag. The drag amounts to, according to the Yale Budget Lab, roughly 0.4% of GDP for the next 2 years. And the tariffs, of course, are creating uncertainty, right? The tariff rates keep going up and down, and the tariff deals also change and are highly uncertain to begin with. And so, of course, now the entire reciprocal tariff regime is before the Supreme Court. And so when rules are constantly changing and businesses don't know what their costs are going to be, they have a very difficult time planning. Should we hire more workers and expand? Should we invest? And as a result, if you look at investment in the United States, outside of AI and basically data centers, investment is flat to down. Residential investment is down. So really, it's AI investment-related spending and the most wealthy households on the back of wealth increases from the stock market that are driving U.S. real GDP growth. Meanwhile, the overall U.S. labor market has basically stalled. The tariffs are creating economic uncertainty both at home and abroad. So our primary international visitor markets, Canada and Japan, have both been hit very hard. They've both experienced negative quarters of GDP growth on the back of falling exports. And so this, of course, leads to a situation where overall economic weakness both at home and abroad, is driving tourism to stall. And that shows up in numbers for the average number of visitors in the islands every day. The gold line here shows Maui average daily census. The light blue line shows the rest of the state. And we separate those because Maui is still in recovery from the wildfires. And actually, the beginning of the year, Maui's recovery was still in place and looked like it was going to be a really good year. And then it really just stalled out. For the rest of the state, it wasn't just a stall, it was a pretty sharp downturn. And unfortunately, with the overall weakness across the entire global economy, U.S. economy, we expect recovery here to be fairly weak. So if you look at total arrivals, U.S. arrivals are basically flat for the year. Canadian arrivals are down about 10% on the back of an almost 10% decline in 2024. And we've seen some bounce in Japanese arrivals, which is really positive. But you've got to remember that Japanese arrivals are still only about half what they were pre-pandemic. So we expect this recent downturn to continue into 2026, relatively weak visitor numbers, and then begin to recover very slowly in the second half of next year. So as U.S. job, and this is on the back of U.S. job growth that's very, very weak and falling consumer confidence, contributing to that weakness in the tourism sector. So where does that leave us for the economy as a whole in Hawaii? We know that job market has stalled, right? Federal civilian workers in the state of Hawaii we've already seen a decline in payroll jobs there of about 1,300 payroll jobs. We expect that decline to peak at about 2,000 payroll jobs by mid-2026. We also expect some decline in state and local government jobs on the back of what is really weak revenue growth for the state. There is some positive notes for lower wage households. The minimum wage is going up on January 1. And so that means if you're one of the 40 to 50,000 people who are making roughly near where the minimum wage is going to be, you're going to see a pay increase if you keep your job. So the people who lose jobs because maybe they're in one of the sectors that's hit more directly by a tourism slowdown, they're likely to find it hard to recover, to get another job or to get a job back. And new entrants to the labor market on the low end of the wage scale are likely to find it harder as businesses struggle with rising costs. Of course, construction is still leading the way, right? Construction is actually the most recent data on construction jobs is a record high. And we expect that to continue on the back of, this is the one area where federal spending is really contributing to Hawaii's overall economy. Now, if you add all this up, you bring all this together, let's look at inflation, the gold bars, and real GDP growth, the blue bars. So Hawaii's inflation or Honolulu's inflation has actually been declining even after the tariff announcements. And we think that's mostly because of how weak Hawaii's economy has been. We also think that the pass-through from tariffs will cause Honolulu's CPI inflation to turn the corner and start to rise throughout the rest of 2025 and into 2026, peaking probably at around 3.5%. So by the end of 2027, we think the price level in Hawaii will be about 1.5 percentage points higher. So a permanent increase in prices for Hawaii residents that acts as a drag on their consumption. In terms of GDP growth, we actually expect that the 2026 number will be essentially zero. The recovery from this downturn will start in the second half of the year, and we'll get back up to mid 1 to 2% real GDP growth in that recovery phase, and then longer term we sort of return to the long-term trend. We'll actually have a report on the longer-term trends in Hawaii coming out in January. We call this a mild recession. So what does that mean? It means people who have jobs and are in sort of stable sectors won't necessarily notice much of a change. They might find that Their wage gains are a little bit slower. They'll certainly, we think they'll find that costs are rising more than they would like with the tariffs. And they might recognize that it would be more difficult to find a job if they were out of work. For those who lose jobs, they're going to feel it most directly, and it's going to be a little bit harder to find work throughout 2026 until the recovery takes hold. So overall, a very mild downturn, a small increase in the unemployment rate, and a relatively weak performance through 2026. So on that pessimistic note, I wish you a happy holidays and mahalo.